Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Agree Realty Corporation Annual Report. Agree Realty Corporation offers a wide range of businesses and services through its portfolio of properties. At the core, the company provides retail space to industry-leading tenants who are omnichannel in their approach. This means that they offer a seamless shopping experience across online and offline platforms. The company's portfolio consists of 2674 properties located in all 50 states, covering approximately 55.5 million square feet of gross leasable area. This extensive network of retail spaces is available for lease to various businesses, including those with e-commerce capabilities. By providing a physical presence through Agree Realty's properties, these tenants can offer their customers a convenient and engaging shopping experience. In essence, the company acts as a landlord, offering space for rent to retailers who are looking to establish or expand their physical presence in different locations across the United States. This allows businesses to focus on their core operations while leveraging Agree Realty's expertise in property management and development. Agree Realty Corp's stock price has increased by 9.6% over the past year, driven by several key news events and financial developments. In late 2024, the company's strategic growth initiatives, including a successful equity raise and analyst upgrades, contributed to its stock soaring to a 52-week high. The announcement of positive fourth quarter and full year 2025 results in February 2026 further boosted investor confidence. The company reported a 4.6% increase in adjusted funds from operations, AFFO per share, and invested over $1 billion in retail net lease properties. Additionally, the company provided optimistic initial AFFO per share guidance for 2026. The declaration of a 3.6% dividend increase in early February 2026 also signaled management's confidence in the company's cash flow. Furthermore, increased institutional and insider investment, including significant buying by Thrivent Financial for Lutherans and Chairman Richard Agree, demonstrated strong conviction in the company's retail-focused net lease portfolio. The Fitch Ratings upgrade to an A issuer rating with a stable outlook in August 2025 also enhanced investor confidence, citing the company's superior tenant credit quality and sector-leading access to capital. Overall, these developments have contributed to Agree Realty Corp's growth trajectory and increased its stock price over the past year. Agree Realty Corporation maintains a market capitalization of $9 billion, broadly in line with the industry peer group. Agree Realty Corporation trades at a higher price-to-earnings ratio of 45 times and a higher price-to-book ratio of 1.53 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 35% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 4.1%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for a company are multifaceted and can be attributed to several key factors. Firstly, significant investments in net leased retail real estate have contributed substantially to revenue growth, with approximately $1.57 billion invested in this area. Additionally, the acquisition of 305 properties for an aggregate purchase price of around $1.44 billion has also played a crucial role. Furthermore, the development of 21 properties at an aggregate cost of $131.2 million has provided a boost to revenue. The The company's ability to execute new leases, extensions, and options on approximately 3,033,000 square feet of GLA, with annualized base contractual rent of $29.7 million, has also been a significant driver of growth. Moreover, the completion of a follow-on public offering of common stock in April 2025 raised net proceeds of around $385.8 million, further contributing to revenue growth. On the other hand, the primary drivers of revenue decline are largely related to external factors that affect the retail sector. The concentration of investments in sectors such as grocery stores, home improvement, and convenience stores makes the company susceptible to adverse conditions impacting these areas. Decreasing consumer demand for products and services offered by tenants, shift from in-store to online shopping, default or financial distress of tenants, and vacancies due to tenant non-renewal or renegotiation of leases are all contributing factors to revenue decline. In summary, while significant investments, acquisitions, and developments have driven revenue growth, external factors such as changes in consumer behavior and market conditions have led to a decline in revenue. Net income experienced fluctuations over the period. Initially, it decreased due to difficulties in adapting to economic changes, potential environmental liabilities, and uncertain tenant lease renewals. However, this trend was not consistent as net income later increased by $15.2 million, an 8% rise, reaching $205 million. Profit margins also underwent changes. They were initially affected by limited reimbursement from tenants and potential environmental cleanup costs. Despite this, profit margins showed improvement, with funds from operations increasing from $343,020 in 2023 to $383,141 in 2024, and core FFO rising from $376,450 in 2023 to $416,712 in 2024. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. A key indicator of this is the positive operating cash flow, which suggests that the business is capable of producing sufficient funds to cover its expenses and invest in growth initiatives. This achievement is further reinforced by the notable increase in net cash provided by operating activities, which rose by $72.1 million over the year ended December 31, 2024. This substantial growth demonstrates the company's ability to efficiently manage its resources and generate a significant amount of cash from its core operations. The company's debt level and interest expenses have undergone changes over the past year. According to page 72, total liabilities decreased from $2,975,785 to $3,526,459, indicating a slight decrease. However, on page 62, it is stated that debt levels have increased significantly, with total debt rising from $320,000 in 2025 to $42,880,000 in 2026. Regarding interest expenses, page 34 reports an increase of 24% to $134.6 million. On the other hand, page 62 states that interest expenses have decreased significantly due to the use of interest rate swap agreements. The introduction of new loans and amendments to existing facilities on page 35 also led to changes in interest expenses. Overall, while there are conflicting reports across different pages, it appears that debt levels may have increased, but interest expenses have decreased or remained relatively stable. Management's outlook for the company is centered around maintaining its current status as a real estate investment trust, REIT. The company plans to continue operating as a REIT and focus on net leased retail real estate investments, with national tenants having investment-grade credit ratings. This strategy aims to expand and enhance the portfolio through development, joint ventures, and acquisitions. To achieve this goal, management will prioritize retaining existing tenants upon lease expiration and invest in restoration or modification of properties as needed. The company also plans to continue increasing capital resources through future offerings of debt and equity securities, which may be restricted due to market conditions. Management acknowledges the potential risks associated with high debt levels, but is committed to maintaining its REIT status. This requires ongoing compliance with current tax laws, which are subject to change. Despite these challenges, management remains focused on paying regular dividends while ensuring sufficient funds are available to support the company's growth and expansion plans. The company has made several significant transactions in the form of acquisitions and divestitures. In terms of acquisitions, the company has issued $400 million worth of 5.6% notes due 2035 through a public offering. Additionally, it has acquired 305 properties with a total purchase price of $1,448 million. Furthermore, the company has entered into a delayed draw term loan agreement for $350 million. On the other hand, the company has also made divestitures. It repaid $50 million worth of senior unsecured notes at maturity in 2025. Moreover, it sold 22 properties with net proceeds of $42 million and recorded a gain on sale of assets amounting to $5.4 million. The company's financial history reveals a consistent commitment to rewarding shareholders through dividends and share buybacks. For over 2 decades, the company has paid quarterly dividends from 1994 to 2020, with monthly dividends introduced in 2021. This demonstrates a long-standing tradition of returning value to investors. In addition to dividend payments, the company has also engaged in share repurchases. Between 2023 and 2025, the company bought back shares through forward sale agreements, with a total of 4,150,000 shares settled in 2023 for $275 million. Furthermore, in the 3 months ended December 31, 2025, the company purchased an additional 332 shares. These actions indicate that the company values its shareholders and is committed to creating value through both dividend payments and share buybacks. Concerns about inventory buildup and supply chain disruption are indeed present in the current market. One major concern is the potential for tenant defaults under existing leases, which could lead to a surge in vacant properties. This in turn may cause difficulties or delays in releasing these properties back into the market. Furthermore, economic conditions may also impact the availability of buyer financing, making it even more challenging for buyers to secure funding and purchase available properties. As a result, this could exacerbate the issue of inventory buildup and disrupt the supply chain, ultimately affecting the overall market dynamics. That concludes the financial summary for Agree Realty Corporation. Feel free to comment below, and I will be happy to answer them when possible.